Kerry Bolton is Australia's most respected exit strategy advisor and CEO of the Exit Strategy Group. Welcome to this week's segment.
So if you were looking to have an investor come into the business, there'd be two questions you'd want to answer. One would be, what type of investor? Are you looking for someone who could be a high net worth individual who would be like an angel type of investor? Or are you in fact looking for some sort of private equity fund or and say someone from overseas, an international investor, or someone who can provide you with some expertise that could be of value to you and your business? You need to sit down and really think about the outcome that you're looking for, and then you can focus and target on the type of investor that you're looking for. Word of mouth is often the best way to find someone. Start talking to people in networks, look to other businesses and see what they've been up to. At the end of the day, somebody willing to invest in your business is going to look for some return, and you need to make sure that you can give them the type of return that they're looking for. I actually interviewed the owner of a business called Skybridge. His name is Glenn Macon, and Glenn recently concluded a private equity deal for his business, which was, in revenue terms, turning over around $50 million. And that was a business that Glenn started from his living room with his wife 15 years ago. And he started looking at his own exit in about 2011 and realised that he needed to change quite a few things in the business in order to make it attractive to a buyer. And one of the major changes he needed to make was, in fact, to take himself out of the business and put in management and get their systems really humming along. The interesting thing was that he actually went to the market in 2012 through one of the big firms, I think it was KPMG, to get some feedback on where they were. And at that stage, there was no interest in his business. And a bit of that was to do with the economic cycle as well. But then a couple of years later, the knock came on the door. It wasn't a case of he went out there looking for for a buyer, but a knock came on the door from a private equity firm that had been keeping an eye on him. And over the course of the next 3 to 4 months, he was actually able to do a deal, which was tremendous. And the lesson in it really is that he spent from 2011 to 2014 getting his business set up so that it became attractive to a private equity firm. That's because he realised that was the best option for him to be able to exit his business. And ultimately, he retained 10% of the business, and so he's now an investor and a consultant to the business. He's very happy with that, and it's given him an opportunity to be able to stand back and look at other potential acquisitions now, so that another 12 months down the track, he'll be getting back into doing things to keep himself very busy, because he's still a young man. He's in his 40s, so there's still plenty of time for him to do great things as far as business goes. I saw that as a terrific example of and a great lesson in what to do if you decide that that's the market that you're aiming for to be able to exit your business. It's about the size of the business and the sales revenues that you have. Naturally, you've got to be very profitable, and there's got to be plenty of upside. When you sell to private equity firms, they can see opportunities and have connections with opportunities that you probably don't have. So when you're looking for investors, think about the type of investor that you're looking for. You only have to look at Shark Tank, that show that's on television right now, and the incredible connections that the sharks have that people are looking for. Not only do they have, of course, the money to be able to invest in the businesses, but they know what the market is all about, and they understand timing, and they understand how the multiplier value will work, and they understand how to value a business properly to be able to increase its valuation at the point of exit. I don't know about you, but it's a great show, and I think it's a terrific example for everyone to be able to take lessons from and know that you need to be structured in the right way in order to be able to attract the right investors. Private equity firms are organisations, particularly in relation to using superannuation funds, and they're firms that have built up and act as investment managers looking for higher returns than they might otherwise get just in putting money into cash deposits and those sort of investment vehicles. So these are firms that work pretty hard to get the funds under management, and then they focus on serving their owners, of course. And so they're looking for businesses that they can invest in, usually revenues somewhere between $8 million to about $88 million. That's almost what you'd call a middle market, although that's not a term that we hear very often here in Australia. Their approach is really one of creating long-term value in the business with which they partner, and they can usually have some pretty good leverage and contacts to be able to grow the business substantially. And they have actually been around for years, but they grew out of the venture capital days back in the 1980s. So, but today they are more prevalent simply because of the great sums of money that are around in superannuation funds. And the way they work is that they will usually buy into your business in one way, shape or form, and then look for what they call an exit within 3 to 5 years. So they want a pretty quick turnaround with the business. They're in there to grow it, not for the great long term, but in order to get a return on their investment in a pretty short time frame. Superannuation funds have billions and billions of dollars. It's not that, but the superannuation funds themselves don't actually go out and make investments in businesses. They look for other funds managers who will do that for them. And of course, being responsible investors of that money, they will just take a percentage of the funds that they have available to put into these types of investments through private equity firms. And the large insurance companies also do the same sort of thing through private equity firms, and also high net worth investors, high net worth individuals will do the same thing. And of course, like any investment, there must be an attractive return on the funds in line with the level of risk that they take. And they're really looking to make multiple acquisitions. They don't just, work with one and see that business on. They make multiple acquisitions based on a set of criteria that they will have agreed with their investors. And the diversification in the portfolio is really important in order to reduce the risk to the investors. So not all of the companies that private equity firms buy are going to do well, but the few that outperform will in fact improve the investors' overall return. And just as a guide, our PE firms investors are really looking for a minimum of around 25% return. That's a huge return in today's environment especially. And they require that as a minimum in terms of your business growth. So alignment between the two parties is obviously crucial, and they'll look to help you build the business and to grow it and to increase its value in the market. One of the other important factors with PE funds is that they actually have a finite lifetime, and that can range from as short as 2 years and could be as long as 10 years. But that's a really important consideration when you're thinking about your own time frame for exit. So at the beginning of a fund's life, the private equity firm executes a series of acquisitions, and they put in their expertise to grow it, and they then will sell when the business reaches the target or when the fund is due to end. So as an example, a 10-year fund, the first 5 years are focused on acquisitions and improving each of the company's performance. And then the remaining 5 years is primarily divesting the firms. Other PE firms will look for a quick entry and exit, or within a 2 to 3 year time frame. The sale proceeds are then shared between any of the company shareholders and the PE fund. And once the fund itself has divested all of the companies, the remaining returns are split between the private equity fund's investors and the fund managers themselves. It's very possible that the owner will lose control of the business when a private equity firm is involved, although it's something that can easily be negotiated. It really is horses for courses. It just depends on the circumstances. It depends very much on the owner as to what involvement you want to have. But 9 times out of 10, the owner won't be controlling the business at all. The business will very much be controlled by the private equity firm. They may put other management in. You may, in fact, not even stay in the business at all. So, again, as I said at the outset, it's very much a negotiation. It's very much dependent on what you as the business owner want to do. It's very difficult, once you've been top dog, to become a middle manager. So you just have to think about that carefully and make sure that your involvement is part of the negotiation and that the outcome is the one that you want as far as you can orchestrate it. So you can often arrange a management buyout with a PE firm, so where the existing management team of the business provides the funds to buy into the business, and the founder and the owner is taken out. So you can structure that type of arrangement with a PE firm, and then the funding and the risks shared. So the new management's given equity, they're given performance bonuses and or options in the company, and then the business is then backed and supported by the PE firm. So that's another option that a business owner could have. Investors can be quite a number of different people. For instance, looking at your employees or key management, they could well be an investor in your business. And if you're looking for an exit using that channel, you could have a management buyout or a leveraged buyout where you help finance the management or key employees to buy in. You could also have just employees in general where you have a managed scheme with employee share options, and there's quite a range of those that you could put in place. I mean, there could be family as well who are going to buy in, and you could set up a trust arrangement. You might have some sort of private annuity working where you're still being funded and being paid from the business. You could even have co-owners where you have some sort of buy-sell agreement. Someone has a first right of refusal. Someone may have a purchase option where they might buy the business, say, in 5 or 6 years from now. You could easily, of course, have the third party, as we've talked about on other occasions, where you do have a negotiated sale. Depending on the size of the business, you could look at a public offering. So you could do a prospectus and have an IPO. Of course, you've got to be a pretty big business for that to be a viable option. And of course, there's just a simple restructuring. You might want to sell a minority stake. Private equity is where that all comes in if you want to do some sort of restructuring. On the other hand, you might want to simply refinance debt. But all of those are viable options in terms of wanting to exit your business. I had a conversation recently with a fantastic small business. They're not a candidate for a private equity investment, but the conversation was around, well, who can I look to if I want to exit my business? Who will buy it? This is a great little business in a niche market, tourism related, and the owners have decided they need to move on. They've got other goals that they want to achieve. In looking at who might buy the business, which is really crucial because you really have to position your business to make it attractive to the type of buyer you want, we decided that the best place to look was within their database. They have about 3,000 people on their database, all of whom were massive enthusiasts. And their business was one that would be ideal for a high net worth individual who might want to sponsor a growing child into the business to be able to have something to do for the next 5 to 10 years. It was quite revelationary, really. Not many people think about looking at their customers when they're exiting their business. They tend to think about third parties. And the other opportunity, of course, was to look at people who are the real enthusiasts for the type of activity that you may be doing in your own environment. So not only your customers, but perhaps even some suppliers could be people that are candidates to be able to invest in your business. This is one of the most incredible financial periods of the human race, in our history to date, simply because we have this huge bubble of baby boomers who will have the most significant transfer of wealth that's ever been experienced in our life, in our existence. So it hasn't been difficult to foresee it. I think it's really enlightening that we now have this 2015 intergenerational report, that we have Dr. Carl spruiking on television, and the pace of change is impacting incredibly. There's never been a better time for anybody to be getting into business, especially the younger generation, because they are so nimble, they're so quick, they've got such fantastic ideas, and the opportunity to be able to buy in to what can be existing businesses to make their life a heck of a lot easier to get the business really pumping is sensational. If I was starting a business again myself, I'd be scanning the market and looking for something that's already existing. I'd be looking for an opportunity that I can get into a business. I would work in it for a little while. I'd get to really understand it. And then I would be looking to buy that business out and chat to the owner and talk about opportunities where they could finance me into that business. So I don't have to bootstrap it and start again from scratch. But I know that there are nimble minds that'll do more for our future than has been done in the last 10 years, simply because of the rate of change that's actually happening. And you know what? I wish I was 40 years younger. I would definitely get into something challenging, because there's just enormous opportunity. So the aging population, the baby boomer population, is still going to be around for at least another 30 years. So let's take it as far as we can in terms of understanding where the future lies, what new industries, what new businesses that we can create, and make the world a better place.
If you don't have a copy of Kerry's new book, The Uncensored Truth About Exit Strategies, please visit freeexitstrategybook.com.au.